You've arrived at clinic number 9. Now that we've nailed down the sweet spot, we're going to talk about profitability. Profitability translates into the sustainability of a business. And there's only two ways to get there: cut unnecessary expenses, cut the fat of a business, not the muscle. So don't just cut aimlessly. Cut unnecessary expenses and control expenses, and increase margin. Do those two things, and you've positioned your business for permanent profitability. That's what you're about to discover in clinic number 9.
Congratulations, you have found your sweet spot. You've identified your top clients and you are serving them to the max. You have a truly unique offering that your top clients love. Your marketing is more efficient and effective in bringing in top clients. You've created efficient systems throughout your business that will support your unlimited growth without trading dollars for your hours. Now it's time to make sure that you are maximizing your profitability. As we mentioned in the last clinic, when the pumpkin farmer identifies his giant pumpkins, he cuts the other less promising pumpkins right off the vine. He stops providing nutrients to those ordinary pumpkins so that all of his resources can be put into the giant pumpkin. The pumpkin plan is not just about growing your revenues, it's also about growing your profit. Now that you have stopped doing the activities and serving the clients who are not going to contribute to your giant pumpkin, your sweet spot, you want to make sure you eliminate any expenses associated with those activities and clients. Use the tools in this clinic to identify and eliminate unnecessary expenses and to set yourself up for automatic profitability. Very often, businesses find themselves operating with little or no profit, or even worse, very little left over for the business owner at the end of the month. The Profit First method, as described in the book Profit First by Mike Michalowicz, addresses this issue with a simple formula. Instead of the traditional sales minus expenses equals profit, this cash flow system flips the formula to read sales minus profit equals expenses. In the new formula, profit is no longer a leftover. It becomes the focal point instead of the afterthought. What does this mean? Practically speaking, it means that you can decide upfront the level of profit you want to earn on your sales, put that money aside, and whatever is left over after that goes towards expenses. This system has also been compared to the envelope method of household budgeting, where you divide up each paycheck into labeled envelopes and use the money in those envelopes to pay for food, housing, utilities, entertainment, etc. In the case of your business, you budget a percentage of sales for profit, a percentage of sales to pay yourself, a percentage of sales to pay your company taxes, and a percentage to expenses. Most small business owners practice what Mike Michalowicz calls bank balance accounting. In other words, if there's money in the bank, you will find something to spend it on. However, in the Profit First system, you are decreasing the amount of money you have available to spend on operations by taking a percentage of your money out of the operations account up front, forcing you to run your business on a lower budget while building in profitability. A major advantage of this system of taking your profit out first is that you get very good at operating your business on a strict budget and managing your cash flow, putting you in a strong position to handle any downturns in business or unexpected negative events. While the process of eliminating the expenses that you cannot afford might be painful, the built-in profit is a big positive incentive to go through it. The good news is that if you have been pumpkin planning your business and are operating in your sweet spot, your business should have naturally become more profitable. The best way to implement this system is to set up 5 different bank accounts which represent your envelopes and name them as follows: income, profit, owner's pay, taxes, and operating expenses. As money flows into your business, it should land in your income account. You will want to establish a rhythm, perhaps once per week or twice per month, to transfer money from your income account into the other accounts. You will predetermine the percentages that go into each account. The owner's pay account is for you and any partners in the business to pay yourselves. Having an owner's pay account will help you avoid the situation where you are paying everyone else but yourself. Each quarter, take half of the money that has accumulated in your profit account and distribute it to the business owners. The key is to pay yourself with this money, not to plow it directly back into the business, which can be very tempting. The amount of taxes your business owes will depend on your business structure as well as your business income. Use the money that accumulates in your tax account to cover those taxes. The operating expense account needs to cover all of the expenses of your business, including non-owner salaries. So how do you know how much to put into each account? The percentages depend upon the size of your business. The book Profit First contains a target allocation chart that gives you an idea of what your percentages should be based on your real revenue range. We have reproduced the chart for you in the allocation percentages worksheet in the download section. Also from the Profit First book, this worksheet contains a chart which helps you determine where you are today in relation to your target allocations. This is the current allocation percentage worksheet. Download the allocation percentages worksheet. Locate the current allocation percentage chart. Starting in the first column labeled Actual, enter your top line revenue for the past year. On the next line, enter your materials costs if you are a manufacturer or if you have a business where the majority of your services are delivered by subcontractors, enter those costs. Subtract the materials and subs from the top line revenue. The remainder is your real revenue for the purposes of the Profit First calculations. On the next line, write your actual profit in currency, not percentage, for the past 12 months. The owner's pay line is how much you paid yourself and your partners in regular payroll distributions, not profit distributions. In the tax line, enter how much your company paid in taxes. This would include corporate taxes as well as any income taxes that the company reimbursed you for. The operating expense line is the total of all of the expenses during the same time period in your business. In the next column, labeled PF%, you are going to list the appropriate percentages from the target allocation chart based on your real revenue number. This is the percentage of each real revenue dollar that should be allocated to each account. In the PF dollar column, you are going to calculate the actual currency amount that would have been allocated to each account if you were in line with your target allocation. These are not actual realized numbers. They are target numbers. You calculate this number by multiplying your real revenue number by the percentage in the PF% column. In the bleed column, for each account, you will take the number in the actual column and subtract the number in the PF dollar column. A negative number in the bleed column means that those accounts are short the amount that they should have if you were allocating according to the Profit First system. For example, a negative profit number means that you are not reaching your profit potential. A positive number in the bleed column means that a disproportionate amount of money went into that account above the target allocation. The operating expense account is typically higher than it should be in most companies, which means that one or more other accounts, such as owner's pay or profit, will be lower than they should be. The good news is that you now have a framework to try to move into your target allocations. In the fixed column, put a plus if you need to increase that allocation and a minus if you need to decrease that allocation. Make a plan to start allocating percentages from each dollar of real revenue that comes into your business so that you can plan your profits. If there is a large difference between your actual percentages and the target percentages, make sure you start small and slowly build momentum. For example, if you had no profits last year or negative profits, do not start with a 5% profit account. Start with 1% with a plan to increase that percentage on a monthly or even quarterly basis. When Mike Michalowicz and Donna Lyons founded Pumpkin Plan Your Biz in 2012, they set up the Profit First system in their business from day one. This process not only enabled them to make a profit and pay themselves starting with the first dollar they earned, but it gave them a framework for creating a pricing and expense structure that would be both profitable and sustainable. Would you like more in-depth help from a Profit First certified accountant or bookkeeper? You can find one at profitfirstprofessionals.com.